Warren Buffett is widely considered the greatest investor of the 20th century. His track record at Berkshire Hathaway, a compound annual return of nearly 20% over 60 years, exists in a category entirely of its own. He achieved this through rules that seem deceptively simple: buy quality businesses at fair prices, hold them forever, and ignore the noise of the market. But despite having access to this proven playbook, retail investors often struggle with panic and underperformance. The problem lies in the gap between the billionaire's formula and our actual resources. Investing is essentially a mathematical equation. The inputs you feed into that formula determine the correct strategic outputs. Buffett's advice remains sound, but it is an enterprise-level formula optimized for a specific set of billionaire inputs that the rest of us do not possess. Look at his actual structural inputs. He has an 80-year compounding runway, a free pool of capital from insurance premiums called float exceeding $100 billion, and a massive capital cushion to absorb shocks. When an ordinary retail investor plugs their own numbers into this billionaire's formula, the logic begins to strain. To see the results Buffett promised, you have to adjust the equation for the life you actually live. Buffett has enjoyed 80 years of compounding. A typical investor starting today has a 30 to 35-year timeline before they need to use that money. That hard deadline introduces sequence of returns risk. This is the danger that a market crash occurs right as you begin withdrawing funds, which can permanently impair a portfolio in a way Buffett never has to worry about. This chart compares two portfolios with the same contributions and the same 7% average return. Yet, because investor B hit a market crash right at retirement, they end up with $320,000 less. The timing of the crash changed everything. The necessary adaptation is a glide path. You gradually shift from stocks into more stable assets like bonds as you approach retirement to eliminate that timing risk. Buying and holding forever works perfectly for an entity that never needs to withdraw. An ordinary investor must adapt because their timeline eventually comes to an end. Berkshire Hathaway has billions of dollars ready to deploy. Most retail investors are building their wealth from small monthly contributions. At this scale, buying individual stocks is difficult. Broker fees eat a larger share of small purchases, and owning only a few companies makes you vulnerable. If one fails, it could wipe out a huge portion of your savings. This visualization of the SPIVA scorecard reveals the difficulty of picking winners. Over 20 years, 88% of large-cap active managers fail to beat a simple index of the broad market. A better adaptation is to use broad global index funds. They provide instant diversification until your capital base is large enough to concentrate on individual stocks. Buffett's methods rely on a massive capital safety net. Without it, individual stock picking can look less like business ownership and more like high-stakes gambling. For a billionaire, a 30% market decline is a paper loss with no effect on their daily life. For an ordinary investor, that same drop can threaten their mortgage and their family's security. This is why retail investors frequently sell at the market bottom. This isn't a lack of intelligence, it's a rational response to genuine financial fear. To stay in the game, you must lower your stock exposure to a level you can actually sustain during a severe crash, matching your investments to your real-world panic threshold. Patiently holding through a crash is a luxury bought with financial security. Establishing a 6-month emergency fund is the prerequisite that makes billionaire-level patience possible. Buffett's framework is heavily concentrated in the United States, relying on the continued dominance of the American economy. For a normal portfolio, relying on a single country creates a single point of failure. If that one market flatlines, your retirement could be derailed. Consider the Japanese stock market. This chart shows a 34-year gap between its peak in 1989 and its recovery in 2024. An investor concentrated solely in Japan saw no real growth for 3 decades. You can adapt by using global index funds. This allows you to capture corporate growth regardless of which country leads the market in the coming decades. What works as high-conviction patriotism for a holding company is often an unacceptable risk for an individual's life savings. While his specific methods might not scale down to a typical brokerage account, the core philosophy, ownership, low costs, and ignoring the crowd remains mathematically sound. This chart highlights the penalty of high fees. On a $100,000 investment over 30 years, a 1.5% fee costs you $264,000 in lost wealth compared to a low-cost index fund. You can follow his advice to buy when others are fearful through a mechanical system like automated dollar-cost averaging. This automatically buys more shares when prices are low without requiring an emotional test of will. The Buffett philosophy succeeds for the rest of us when it moves past raw psychological endurance and into automated systems. The adapted framework starts with a foundation of an emergency fund, a core of global index funds, a demographic glide path, and automated behavior. Adapting these rules ensures the tools actually function in the real world, calibrated for your specific timeline and risk. True respect for Buffett's approach means analyzing your own mathematical reality with the same cold, objective rigor he applies to his companies.